All right, gang, it is that time again. We're welcome to it's live stream now. So if you're joining us live, feel free to throw comments in as we go. If you were joining us after the fact, so maybe you're catching us on YouTube, then go ahead and leave any comments that you'd like, and we will certainly get to those. But for those of you that are joining us for the first time, my name's David, and I am a longtime investment guy, certified financial planner, and we have been developing this as a resource for basically, for younger folks or their parents. We're trying to talk a little bit more about the investment world, the world of money, and do it in language that you understand rather than doing it in language that is maybe confusing or buried in the industry terms and jargon. I don't want any of that. I want to make it nice and easy to access, so that's what we're up to today. So we're going to be talking today about mutual funds. Now, if you haven't caught any of the previous classes, make sure you can go to YouTube, and we've got them all logged there, and you can get caught up. But we always jump in first, so with our let's see, got to click our bonus question that we finished from last week. And this was a fun one, right? This is an interesting one. How do you, we know that you make money in investing in a simple way, right? You buy low and sell high. Everybody's, we get it, buy low, sell high. But can you make money other ways? And here's the thing, you can buy high and sell low. This is going to sound really weird, but this happens in real life a lot. So I'm not going to talk about the stock market. I'm going to talk about buying a car. Let's say that you went to a car dealership and you wanted to get a fancy new, SUV, or let's do something cool. Let's say you want to buy a Tesla, right? You want to go buy a new Tesla. So first of all, sweet, you got the money to buy a Tesla. But anyway, you go in there and you say, I really want to get this fancy car with all the features in it, but you know what? You don't have that one here at the showroom floor, right? You have a blue one, but I want a black one. So guess what? They're not going to sell you the car, right? Are you kidding me? Of course they're going to sell you. In fact, they're going to give you the exact car you want. They're going to get you the black one with all the features and everything. And you're saying, but David, they don't have this on the lot. I said, of course they don't. And yet they will drop the paperwork. They will take your money because what are they going to do? They're going to go get it for you. So they are going to sell the car to you, and then they're going to go get it from somebody else because they know that they can pick it up from another dealership or another space for lower than the price they're selling it to you for, so they can still make their money. So what did they do? Well, they sold it to you at a higher price, and then they were able to buy it back lower, essentially. So they didn't buy high. I guess I should flip this around. I hate when I do this, right? What I really need to say is, we know to buy low and sell high, but what does it mean to sell high and to buy low, right? Because they sold it to you first at the high price, and then they bought it back lower from somewhere else and delivered it to you. So what do you end up with, right? You end up with the exactly what we just described is they're going to sell you. They did the money in reverse, right? So that there's a process of this. It's called shorting. And in the stock market, shorting means, okay, before I own it, I sell it. Okay, so I have to borrow it from somebody else to do that. And this is just what the car dealership did, right? They borrowed it from another dealership. They knew it was there. They sold it to you, and then they went and collected it. And we can do the same thing in the stock market. Now, if you think a stock is going to go down in value, you can short the stock. And it's a little weird to do because you have to have an account that allows it, and you have to borrow the stock, which means you have to borrow money to do it. You have to borrow and pay interest. So it's something called margin. I'm not going to go into a lot of that today, but just know you could do this. You could actually sell the stock before you bought it and then buy it back at a lower price, and you make the profit on the difference between what you sold it for and what you get to rebuy it lower for. So there you go. All right, so today let's talk about mutual funds. Mutual funds are really, really important tools for investors. So we're going to talk about what are they, how they work, and some things to watch out for. And I'm going to have fewer slides today. I'm going to show you some things online and show you how you can look stuff up using free tools, and you can do a little bit of your own homework and learn about this stuff. But mutual funds they're important because they allow people to get started for a lower price if you want diversification. Okay, what does that mean? Well, you've heard we just finished Easter, right? And the joke is don't put all your eggs in one basket, right? Because if something happens to the basket, you're in trouble. Well, it's expensive to buy some stocks. If you wanted to go buy Amazon today, it's over $2,100 for one share. And since you can't buy part of a share of Amazon in most places, you can now, right? If you go to certain services, you can buy part of a share of Amazon. But then it's a little weird because you have to buy a fractional share, which means you have to do it through companies that allow it. So you're still accessing through a company, and that's why mutual funds still matter, is because mutual funds will sell you fractional shares, and then you're not just going to buy one stock. You can buy fractional shares of lots of them. So you can be diversified. You can buy and not put all your eggs in one basket. But you do it through a company. The company basically takes you and all your friends. I joke because maybe you don't know them at all, right? I mean, a bunch of people take their money, pool it together, give it to a company who hires a team of people to buy investments for you. Okay? So what is the mutual fund? It's a group investment. Okay, it's through a company. It's professionally managed. Maybe it's a manager. Maybe it's not. Maybe it's just a formula. Maybe there's no people running it. Maybe it's a formula, meaning, hey, we have a template for how we do what we do. Like, this is the rules. We'll just go buy the same stocks every time. Like, for example, if you buy the S&P 500, that doesn't take a manager. There's no person saying, well, I wonder what 500 stocks they are. It's a pattern, right? We know that these companies are in the S&P 500. So we all get the S&P 500. They buy the 500 stocks in the appropriate ratio. That's a computer that can do that. That doesn't need to be a person, so you don't have to pay extra people for it. You just get the computer to buy it for you. So anyway, that's what it is. And how do these things work? So there's some things that are in common with all mutual funds, and then there's some stuff that you need to watch out for. So let's talk a little bit about the ABCs of mutual funds. And I kind of already talked about this, but we talked about it being a pooled investment. We need to know there's two major types of mutual funds: open-ended funds and closed-end funds. Okay. Most common are open-end. And that just means that, hey, they already invested the money for everybody that pooled their money, and you want to join them, right? You want to show up and you want to buy some shares too. They'll take your money and they'll just make new shares, right? Because it's open, so they can make more shares as more money comes along. So they bring your money, they put it in the pool, they give you your proportionate ownership. Like, you don't buy all the shares, you get your little piece. And so you put your money into the fund, and now you have representative ownership of the same basket of securities or investments that everybody else does, according to how much you paid in. And they just made new shares, right? That's what an open-end fund does, is it keeps making new shares. Remember we talked a little bit about stocks, and we said, what happens if a company buys its own stock back? And it means there's fewer shares available. And so we had supply and demand issues now because the supply is different when companies buy up their own stock. Well, mutual funds, when they're open-ended, they don't really have supply issues like that because they can just issue new shares. What if it's a closed-end fund? Well, they're not issuing new shares anymore. So now if you want to buy those shares in a mutual fund, you may have to pay more to get them because they're not making more shares. So you have to go buy them on the open market. You have to have somebody willing to sell them to you. So that's part of the issue, is that a closed-end fund is a little different, and so we care about those. Now, maybe in a later video we could talk about exchange-traded funds, which are sort of like closed-end funds. They trade on the stock market like a stock, even though it's not a stock, it's a basket of stocks that a company created, and then they issued a certain number of shares and they put them out in the marketplace available for trade. They're a hybrid. We'll talk about those some other time. But mutual funds, if you want your, what do you do if you want your money back? Well, you go to the fund company and you say, I'd like my money back. And maybe there's paperwork or you have to call them or whatever. But what they do is they redeem your shares and they send them back to you. This is where mutual funds are a little weird, right? Now I don't have a slide for this. Oops. In fact, I thought that was gone. This is fun. We'll order this on the fly. This was from our previous presentation, so we don't care about that, or even that, but we do care about this. So let's just insert a blank slide so we don't have distractions, and we'll talk a little bit about some of the ABCs of our mutual fund. So if we want the money back, what do? We have to ask for it, right? We go to the company and they'll give it back. How much do they give back? It depends on a couple things. One, mutual funds, they're buying and selling stocks all day long. They don't tell you how much money you have until after the market closes, because they need to tally up all of the buys and sells they made and how many people wanted money in or out. And so they don't know until the end of the day, after everything is shut down. So once the markets close, then they will tell you how much they're going to either charge you to buy. If you wanted to buy today, you don't know until the end of the day what the price is. And the same thing if you want to sell. There's another thing that you should know about all mutual funds. I'm going to just sort of write this on screen as we go here, and I'm going to write it in really big letters, right? So we know that there's A, B, and C. These are share classes. Again, confusing term if you don't know what we're talking about. But what it means is if you buy a mutual fund, you have one of three things. And I'm also going to include down here, I'm going to space out N. It used to be when you bought things from a stockbroker that you had to pay a commission, right? If somebody bought it for you, this was years ago, but you bought something and then they would pay you. So if you go to a professional and you buy a mutual fund, and they're going to charge you some kind of sales charge. And that's a Class A transaction. That means that the mutual fund has built-in compensation to pay somebody. And they charge it a sales charge, and it's upfront. Okay? Type B has a sales charge, and it's deferred, right? And what happens on a deferred sales charge is that you end up paying, I'm trying to make this bigger so it all fits like that. You don't pay the upfront sales charge, and that's nice. I mean, if you have $100 and you buy a mutual fund, with a Class A fund, you may spend $4 or $4.50 on commissions. So you only have $96 in your account after you invest it. Well, when you buy a B share, you put $100 in the account immediately. But there's a catch, right? If I sell it too soon, if I don't hold it long enough, then they charge me to sell it. And so then I get I have to pay on the way out. And then C has a sales charge and then a sales, we call it a load, right? What it means is that it's lower than an A share, but it's not B. Right? C is cheaper to buy because it's only usually a 1% fee to buy it up front. But in the 13th month, then they start to charge you for keeping it. Okay? It sounds a little weird. You don't need to worry about it, but you need to know, am I buying A, B, or C? Because it's kind of like, what kind of mileage do you get in your car? Do I get really good mileage or not? An A share means it costs me the most up front, but it's the cheapest to run, so it gets the best gas mileage. A B share doesn't cost anything up front, but it costs more to run it, so it doesn't get as good a gas mileage. But after about 7 or 8 years, it usually changes to an A share, so it gets better mileage later. And then C share is, it costs a little bit up front, So it doesn't get as good a mileage as A shares or B shares, but it costs less to buy it. Uh, it's a little weird, and I'm going to show you why in a second here. And then N, what ABC and N? N is no sales charge, right? Or no load is what they call them. No load funds. They don't. There's no. You can buy those yourself. If you go to Vanguard and buy a no load fund, you don't have to pay some silly extra charge to buy it. So it's the cheapest to buy. But keep in mind, you have to do all of the work, not somebody else doing it for you. So those are the primary types of funds. There are other types. Okay, lots of types of share classes, and they all have different price structures. So here's what we need to know. Let's look at, we've got Yahoo Finance on Google. All right, so let me just bring up Yahoo, and let's look at a mutual fund. And which fund are we going to look at? Let's see if I've got one easily available. So I don't here. I'm going to use MIG, I think it's FX. Okay, so this is a really old mutual fund. And when I say old, I mean like old. Look at this thing. It was started in 1935. But what can we tell about this mutual fund? Well, we know several things, right? We know that its last dividend was 9 cents. We know that Friday, because today's Monday, it was $28.78 a share. So far this year, it's down 17.81%. And this is the important one here. What's the expense ratio? How much does the company charge you to have this fund? So let's do some math, okay? Let me pull a calculator up on screen and we'll put it right here. And we know if we have $100 in this fund, okay, and part of it is 72% is expenses, right? Then I know that if I multiply this by 72, right, not 1%, so there's 0 and 0. So if I had 0.1, it's 1%, but 0.072, it costs 72 cents to run this fund for every $100. So that means that if the market goes up only 0.72%, you will have paid, or you will have made no money because you would have had to pay this expense out of your total return in order to buy this fund. Okay? And this also has, because this is a Class A share, it has an upfront sales load. But that's something that's important that we want to look at. We want to know, this also way, if we wanted to look for more information, you could go to Morningstar. They're a risk rating company, so you could do more research, right? And you can see this is a 4-star fund. But I chose this because this was the first mutual fund I ever owned, personally. And, we can talk more about strategies later. We're running a little long today about how to buy mutual funds. But what you need to know is they're priced kind of funky, right? A shares, B shares, C shares, I shares, which stands for institutional. They have retirement shares. They all have different expenses, and then they have different upfront costs to buy them. So those are the elements that are very important. Now you'll notice there's a bunch of other things that you can look for, and I would encourage you, go to Yahoo Finance and look. And here, this is called a ticker symbol right here. That's the identifier for a mutual fund. So if you want to look at how do I look one of these up, go look at the identifier symbol, put it in here, and then you can go look at this. And we could say, see, this has a really long history. We have data that goes all the way back here to 1973, and you can see that it's gone up and down over history, and then it's gone pretty high since this was 2008 back here. The story about this fund and why it's so funny to me personally is I bought it right in here at about $18, and it went up to 20, and then it collapsed down here to about 9. So it got cut basically more than 50% when I owned it. And here's the real trick is I ultimately sold this at a profit, and I sold it somewhere around 2004. So if I owned it for 5 years and it lost value, How did I make a profit? So that will be our bonus question, because tomorrow I'm going to talk about strategies to profit even when prices are falling. Okay, so that'll be a weird one, but that'll be what we follow up on tomorrow. So for now, I'm going to do what we also do. If there are questions or things you'd like clarified, give us a call or email, right? You can send an email to info@littlejohnfs.com. And also remind you, for parents or anybody watching, we've got a bunch of free resources on our webpage. There's under the Educate tab, you'll see there's a calculator. This is really fun if you want to do examples with your kids about different ways that money works. So we have these calculators for how much might your investment be worth in the future, or how much might your retirement be worth in the future. Should I buy or lease a car, that kind of stuff. There's a bunch of calculators on there. I would encourage you to check them out. Okay, so this one got long today and a little less organized. I apologize for that. But anyway, for those of you that are still watching these, thanks for tuning in. And again, please comment, and we're happy to get you more information. Until next time, this has been David Littlejohn, and I am signing off. Take care, gang.